Why do some falling companies collapse while others recover from their failures and become profitable again? This concept lies under management top concept that all the business students, professionals and owners must know, which is called the corporate restructuring and turnaround strategy. Today in this lecture we will be discussing that how disruption in any industry or attack from any innovative firm, how existing companies can restructure themselves and become profitable. So, on extremely basic level, corporate restructuring involves the major changes in business structure so that the company survives in the market, and it is aimed to improving the efficiency and definitely the financial performance. Recently we came to know that for the first time when the Toyota company was made, they are going in the loss, and reason is because the electric vehicles are coming there, and the same happened with the Fords. When the fuel efficient cars were made, they need to change themselves. Earlier Fords ruled the world till 100 years, and same was the case with the Toyota. But now with the electric vehicles are coming, so these companies need bigger restructuring, and they need to change their focus. So this is the core thing where our corporate restructuring fits, often undertaken in the crisis and strategic repositioning. Definitely the bigger companies facing the crisis, they restructure themselves. Why firms restructure? Five reasons. First is decline of the profitability. If you see, I gave you example of Toyota. The traditional companies are facing the decline in the profitability in the era of AI. So now they have to opt it, they have to opt the technology. Second thing is financial distress. They might not be getting enough funding, they might not be getting the shareholder support. So the financial distress is a big problem. Third thing is disruption. So just like in the cars, the electric vehicles are coming and the fuel efficient cars are these days facing the disruption. And technological changes, obviously technology is changing. And the last is strategic alignment need. So as the world in every century sets its goal, and those companies who survive, they change themselves as per need of that time. Types of the corporate structure restructuring are four. One, companies make the financial restructuring, that how they earn the money. Second thing is operational restructuring. They may be change the assembly line to something else. They can think of outsourcing. They can think of transaction cost economics, which we studied in our lecture number 44. And organizational restructuring, companies can also think of it. And portfolio restructuring, which is core corporate level strategy. The companies move into some other business. For example, corporate restructuring of the Apple was done when they were mainly dealing with the mobile, with the laptops, and in 1990s, in 1986 they decided to go into the phone business, and because of the phone business they are one of the leading multinationals. And those companies who stayed in the laptop business, for example the IBM, they suffered a lot. IBM nowhere in the mobile phone, in the laptop production is close to the Apple these days. Financial restructuring means debt restructuring, equity issuance, asset sales, and capital restructuring optimization. Operational restructuring means the cost reduction initiatives, the process redesign, the supply chain optimization, and the efficiency improvement programs. And similarly, the organizational restructuring means change in the leadership, thinking of someone bringing the young blood in, departmental reorganization, downsizing or right sizing, cultural transformation. These things are happening because of the AI a lot. This is called organizational restructuring that company do to survive in the long run. And portfolio restructuring means the diversifications, going into the different businesses, spin-offs, acquisitions of the new companies, and refocusing on the core business. So these are the portfolio restructurings. What is turnaround strategy? Turnaround means that strategy aim to revive the declining companies. The declined companies make a strategy that helps them to be relevant again, and it focus on restoring the profitability thing first of all, and often implemented during the services, during the severe crisis. For example, in the AI situations, a lot of companies are going in the going in loss. They have to make the turnaround strategy. Stages of the turnaround strategy. First of all, they kind of understand when the decline happen. They realize, okay, our revenue is declining, our customers are going to the new people, and our customers are complaining about our product, and we are no more considered as the people who are innovative. Second happens the crisis stabilization. When the company turn around, they make the changes, and then the crisis stable. They kind of even reach to the break even point, or sort of customers start saying that they have stabilized, they are innovating themselves, they're making themselves better. Does not matter whatever strategy is it can be financial restructuring, operational restructuring, or portfolio restructuring. So all the people, even if the financial restructuring, say that they know the company have stabilized. The third stage is that companies need to start repositioning as the new company. For instance, the telecom companies earlier used to say that we are phone call companies. Now they say they are internet based companies. So the companies were mainly focusing on producing radio frequency products earlier. Now they are focusing on cloud computing products, the internet of things. So this is called the strategic repositioning of the companies. And eventually with the new positioning, they grow, they make the recovery. So these are four stages of the stages of turnaround strategy that all companies must do. Retrenchment strategy is about cost cutting, asset liquidation, market exit, or short term survival focus. Companies can also go for the retrenchment strategy. Recovery strategy can be new product introduction, market expansion, innovation initiatives, rebuilding brand image. So early warning signals of the decline. When companies know that they maybe they are declining, the early thing is that there is a decline in the sales. This can also happen. There is a decline in the cash flow problem. There's high employee turnover, employees going somewhere else, and customer dissatisfaction. This, if some company is facing these things, they can say that they are in the declining stage. And strategic leadership can help in the turnaround. Strategic leadership, what they do, strong crisis leadership is required. Strong leadership is required in the crisis. Quick decisions must be made about the product, about the finances, about the structure, and transparent communication is extremely important in those situations. Stakeholder confidence rebuilding is extremely important. We saw in the COVID that those companies which had the strategic leadership, they turn around the things, they survived in that crisis. Corporate restructuring versus mergers and acquisitions. Yes, this happens a lot in the corporate restructuring time. That restructuring is about the internal change the companies make, where mergers and acquisitions are external expansions, and they both aim to improve the performance. And definitely these are two different aspects. Companies can also go into the merger when they are in declining stage, probably maybe innovate themselves, reposition themselves. Two companies can work together to meet the needs of the customer, to meet the needs of the technology. In banking sector, we can say that companies do the in turnaround strategy. They do the capital injection, they do the regulatory interventions, they do the risk management, they do the governance restructuring. We saw the, for example, Lehman Brothers in financial destruction that happened in the 2008 because of the houses. At that time, a lot of capital injection was done in the banks to save them. There were certain regulatory interventions. This happens in the banking sector for turnaround purposes. Corporate restructuring in the age of AI. AI is definitely going to transform a lot of things. The first thing is digital transformation. Everything is happening digitally. People expect the transparency, accountability, and merit. And earlier, even though people always wanted the merit, but the tools, the technology was not that much equipped. But now we can say that the level of the technology is on such level that every person can use the AI, every person can use the cloud computing software. So the digital transformation initiative is restructuring in the age of AI that makes the restructuring easy. Automation driven cost reduction. Companies always wanted automation, and because automation costs less, automation makes things less hectic. Automation helps the companies in making more informed decisions. So the cost automation driven cost reduction is something that corporate restructuring in the age of AI is happening. Data driven restructuring decisions are happening a lot. Earlier there used to be complete teams doing the performance analysis, market analysis. Same AI is doing and informing the management more frequently than the humans. And AI based, there are performance metrics people are making, so that is also helping the companies in the corporate restructuring. Advantages of the restructuring: if you are in the difficult situation, then definitely restructuring improves the efficiency, it better financial stability, it gives you strategic clarity, and it also enhances the competitiveness. The restructuring is also tough, especially when you need less people. Uh, when the employees are supposed to work hard, they need to learn new skills. So you get resistance from the employees. You get the cultural disruption. Maybe people used to do the things in different way. Now you are restructuring things must be done in other way. Execution strategy risk can also happen. The people might not be are skilled enough, there might be a skill gap and willingness gap, the execution risk is there, and short term performance will definitely decline. So this is the risk of restructuring. Case studies of IBM turnaround shift from hardware to service. For example, IBM, I was talking about that in the last lecture, that when the companies decide that they need to restructure themselves, so IBM shifted from the hardware to the services business. I used their Watson tool for the analysis. It was important back then, but now keeping in view the bigger platforms are also coming in AI and analyzing the data, IBM still might be positioning of repositioning itself. Strategic repositioning, IBM did focus on innovation and long-term achievements rather than on the hardware. So there's an example of IBM that restructuring themselves from hardware to software because they realized they are no more compatible with the latest world requirements. Nokia decline is also failure to adopt the smartphone revolution, strategic misfit, and delayed it, and then they were sold to the Microsoft. Students must understand the restructuring clearly, what is it, and they must understand what are the turnaround stages, differentiate between retrenchment and recovery, give real world examples we explained in this lecture. And managers must monitor performance continuously, act early during the decline, because you can recover your changes, and secondly your customers are also learning, their demands might not be that high, but if you be late, then definitely there will be lot of highly innovative products, and it's extremely difficult. For instance, for Nokia, it was difficult to catch up the changes that happened because they have not made the things decisions early. Align restructuring with strategy and use AI for productive risk management. Mistakes people make, they delay the response, ignoring stakeholders, shareholders, overcutting the essential resources, and obviously lack of vision and clarity. Key takeaways, we can learn that restructuring improves the organizational health, turnaround restores the declining firms, leadership is critical, and AI enhances the restructuring decisions in 2026. One thing I want to say in the summary, I have seen that a lot of companies, when they face problems, they start reducing the cost, closing the major important functions, and eventually they die. The agenda is not the research, the cost reduction. The agenda should be cost optimization, and I learned it from my manager, from the CEO of China Mobile, Li Yongfang, that Chinese people, they focus on cost optimization. It means spending the cost where it matters. If your some product is selling, better sell that product. If your some product customers still say that they need it, better innovate that for the next generation so that you restructure yourself, but also by being in profitable, because restructuring is also risky. You might fail, and a lot of companies uh, try the restructuring and they fail badly. Few companies realized, okay, we can not restructure, they go for the mergers and acquisitions. That is also important concept that we explained earlier. See you in the next lecture. I hope you find this lecture useful. Share it with others if it's useful. Thank you.